Welcome back to our intermediate financial accounting class. In our last segment, we started talking about leases. We talked about why they're so important and then a few definitions, but mostly we focused on the importance of this topic for both the financial world and for us as accountants. Because it's so important, FASB's come up with some really detailed rules to make sure that we account for leases in an accurate way that portrays what's really going on in our contracts. And the very first issue that we have to address is how do we account for this lease. And there are three specific questions that FASB wants us to address in order to determine what that accounting style will be. So let's take a look at these questions. First off, is it really a lease? Second, how many components are included in the lease? And third, how do we actually classify the lease? And we're going to talk about each of these in a little more detail. So let's go ahead and start with whether or not an item is really a lease. Now, for most people, the question about whether or not an item is a lease has to do with legality. What's the contract look like? But we're not as concerned about the contract when we're talking about accounting. We're more concerned with meeting FASB's requirements, not the legal requirements. So something can very easily be legally structured as a lease, and we can look at that from a GAAP perspective and say, nah, we're going to account for that as a sale, or we're going to account for it as just some financing, or we're not even going to touch it. So because of that, we have to start with these first couple of questions to determine from a GAAP perspective, is it a lease? And the first question is whether or not there's an identified asset. What FASB is trying to avoid is a loose contract that really doesn't specify the item that is being leased out. And we want to make sure that it's really very clear which asset you're getting if we're going to call it a lease. So the rule here is you either have to have a very specific asset that's either uniquely tailored to the company or specifically identified in the contract. I get that one. Or it has to be so general that it doesn't matter. So let me give you an example of an identified asset. Let's say that I go to a dealership to get a rental truck for my business. And as I'm negotiating with the salesman, I mention that I need very specific size and style. Because of the heavy items that I'm going to transport, I need very specific shocks, I need larger wheels, I need a very strong chassis, etc. with this truck. So because of that, we're limited to a very specific kind of truck that are reinforced. There's two ways that I can call this a lease. Either he brings out a very specific truck with a specific VIN number and says, this one's yours, it meets all of your qualifications, we'll give you this one. Or he takes me to a style. He's got 10 different trucks that all look the same. They have the same reinforcement. They all look exactly the way I need them to and can do what I need. And he says, choose. You can pick any one. If it breaks, don't worry. I'll drive one off. I'll bring the other one back. There's no problem there. They're so close to each other they don't need to be identified because any one matters. The only difference is paint color. So doesn't matter. So what we're saying is the contract either has to specifically say you get this blue truck with this VIN number, or it has to say you can choose any one of these 10 trucks that all are exactly the same except the VIN and the paint. And as long as that's the option, then I can call it a lease. If on the other hand he says, well, there's this truck and that truck, and this one has the chassis that you want, but this one has the shocks that you want, which one do you and we don't specify which truck I'll actually get, then I don't have a lease and I have to treat it a different way. So that's what we're looking at with a specific identified asset. Second, as the lessee, do I have control of the asset? What FASB wants to ensure is that I'm not just controlling the output of the asset, I actually control the asset itself as part of the lease. So for example, I want to lease a machine that produces widgets. And we have two ways to do this. I can go to the company that makes it and they can say, we'll lease you this machine and you can take all of the production. We'll run it, but anything it produces will belong to you. We'll just leave it here and it'll be fine. Or they can say, yeah, here, take the machine, integrate it into your line, make sure that it fits. If you need to tweak it a little bit, you can so that it does just what you need it to do, and you decide what the output is going to be. The first option is not considered a lease because all I'm getting is the output of the machine. I would have to treat this as a sale of all of those output items as opposed to me leasing the machine. When I take it to my business and I control it and I can move it around and tweak it and do what I want with it, then it's a lease. The other part of that is not just can I control what it does, but I also have to be able to control the benefits the machine produces. So assuming that I have either a very specific asset that is definitely mine, you get that one that's blue with that chassis, and I can control its output, and I can control the benefits, then we move on to our second question. How many components are included in the lease? Now, we've talked about this a little bit with revenue recognition. It's the same basic idea. We get into the contract and we start looking at how many pieces are really involved here. If you're renting or leasing land and a building on the land, can I use the land separate from the building, or do I have to have the building, or do I have to have the land to use the building? If the land can be separate, then I have 2 leases. If the land and the building have to go together, then I have 1 lease. And the accounting is pretty much the same. We're just splitting them up so that we have a better image or better picture of what's really going on in the contract. But the accounting all ends up being the same. We just end up with extra journal entries, really. But the classification has to be the same. The calculations are all about the same. We've just split them up so that if you decide, I want to buy the land at the end of this, but I don't want to keep the building and the land that it's on, I just want the parking structure area, then it's already separated out and I can control that asset separately. And I can depreciate it different, or I can return it or contract, whatever it is I'm doing. I have better control, and the accounting allows me to show that control if I split them up. So that's what we're looking for. They're the same rules as they are under revenue recognition. Do they stand alone? Do they provide a benefit on their own, or with stuff that I can get on my own? Again, I don't have to buy stuff from the lessor. Are they independent or not highly interrelated with other parts of the asset? Again, can I just use this one piece? If I can, I separate them. If I can't, I treat them as the same item, just like we do with revenue recognition. The next question is, how do I classify the lease? And this is going to be different whether we're talking about the lessee or the lessor. And we're going to start with the lessee because it's more common to work for the lessee than it is to work for the lessor. But don't worry, we'll get to both. For the lessee, what I'm looking at in determining how they get classified, is it a finance lease or an operating lease? A finance lease means that I have essentially bought the item and you have simply provided me with financing, so I don't have to go to the bank or to the stock market and get the financing separately. If it's an operating lease, then I haven't really bought it. I'm only using it for a short period of time. For a finance lease, if you're going to own it for most of its useful life, then it's a finance lease. If you're going to own it for an insignificant part of the economic life, then it's an operating lease. So for example, let's go back to my truck. Good truck, delivery truck, lasts 4 years. If I'm going to own it for 3.5, finance. If I'm going to own it for 6 months, operating. The present value of the payments is for substantially all of the fair value at the commencement of the lease, so on the day we begin. So my delivery truck is $25,000. If the present value of my lease payments, including a bargain purchase option or a guaranteed value, is equal to, say, $22,000, yeah, I've paid for most of that asset. So I would count it as a finance lease. If, on the other hand, I'm only going to own it for 6 months, I'm going to pay $10,000 over those 6 months. That's not close enough. It's not even half. So that would be an operating lease. The last major classification, and there are some other small ones, but these are the 3 big ones. If I have a significant incentive to keep that asset, either by renewing the lease or buying the asset outright, whether it's in the contract or just because, if I give this back to you, it's going to mess up my product line, I got to keep that thing. Whatever economic incentive I have, if it's a significant incentive to keep the asset, then I treat it as a finance lease. If, on the other hand, there's no real incentive, then I don't call it a finance lease. I call it an operating lease because I have no reason to keep it. So, for example, let's go back to our delivery truck. I own it for 6 months. I'll get a new truck at the end of that 6 months, or I'm just waiting till I can buy one that I really want. I don't have any reason to keep this thing. When the lease term runs out, I give it back. I'm done. If I get to the end of the lease and they have said, at the end of these 3.5 years, that's going to be worth about $5,000. We'll sell it to you for $3,000. Hey, I might as well do that. Even if I don't keep it myself, if I can buy it for $3,000 and sell it for $5,000, I'd make $2,000. Yeah, let's do that. Okay, now I've got an economic incentive to buy it when the lease is done and keep it for a little while, even if I'm just going to sell it off. So that's what we're talking about with this last classification. Now, once I decide how to classify it, then I'm finally ready to do the journal entries. And luckily, they're relatively similar. So the first couple steps are exactly the same. I have to create what we call an amortization table, which we've done in the past with bonds. Now we're just going to switch it to a leased asset. We're then going to calculate and record a right of use asset, that's what we call a leased asset, and a lease liability. We'll do that for both finance and operating. Then each period we'll record the payment, accrued interest, and amortization. Now, the way we'll do that is different. Under a finance lease, you'll see that we're looking at interest expense and an amortization expense. Over in an operating lease, we're going to look at a lease expense, and we're going to break that down into interest and amortization, but we're not going to call it interest expense and amortization expense. We're just going to call it a lease expense. So that's the real difference. At the end, we'll transfer the right of use asset. If we're giving it back to the lessor, because we're just done with it at the end of the lease, then I get it off of my books. If I'm going to keep the asset, then I transfer it out of a right of use asset and into traditional PP&E. Now, the lessor has a similar set of rules, both for how we determine which way we're going to classify it and a set of steps. But I want to focus on lessees first, and then we'll come back and we'll do the whole discussion of lessors all at once. So we're going to stop here. When we come back, we'll start doing journal entries for the lessee. And then when we finish looking at lessee accounting, then we'll look at lessor accounting. So next time, we get to start doing some journal entries. All right, let the fun begin. We'll see you then. Thanks.